Welcome back to Stock School Daily.
103 million guaranteed buy orders. That's a heck of a foundation. Just to put that into perspective for you, that's like one obligated buy order for every single person living in Texas and Florida combined. The sheer scale of that risk, just in volume, is enormous.
It is, and that huge number leads us right into the next big theme in your sources.
Which is the skepticism around the data itself.
Exactly. The idea that the official numbers might not be the whole story.
So this is where we get into things like reporting delays and potential concealment.
Right. This is where the risk starts to multiply. You have what the sources call the discrepancy, official exchange data. It has a lag. The last report showed about 93 million shares short.
Okay, 93 million.
But real-time data providers like Ortex, which is cited a lot in these documents, they're showing a number closer to 104 million.
So an 11 million share gap in just a matter of days. What does a gap like that signal?
Well, according to the sources, it signals one thing. They're not covering. They're not closing their positions. They're doubling down.
Wow.
They're aggressively shorting more shares, that extra 11 million, since the last official report. The analysis is that they're trying to suppress the price, and in doing so, they're just digging themselves a deeper hole.
And this all comes back to the fact that the data is self-reported, right? The sources call this the self-reported data trap. Why do they say that 103 million figure is the floor, not the ceiling?
Well, think about the incentive structure here. You have institutions that have made a huge, very public bet against a company. When it's time to report their positions, they are highly incentivized to report the absolute lowest number they can get away with.
Why is that?
Because a higher reported short interest brings more scrutiny, and critically, it can increase the collateral they have to post for their position. So that 103 million, the sources treat that as the bare minimum they have to admit to. It's the floor.
And this is where it gets really interesting, right? The mechanics they might use to hide their true exposure. What kind of massive hidden short positions do the sources suggest are being left out of these official reports?
The documents point to three main methods. The first, and the most complex, is hiding short positions in things like swaps and other derivatives.
Wait, hang on. How do you hide a short position in a derivative?
Well, a swap is basically a private contract between two parties. It happens off exchange, so it's not subject to the same reporting rules. A fund can use a swap to get the same economic result as shorting the stock. They profit if the price goes down, but they never have to report an official short position. It stays in the shadows.
That is clever and very opaque.
Yeah.
What about the other methods, the idea of marking errors?
That's the second one, and it's much simpler. It's when a short sale is just illegally mislabeled as a long sale.
A long sale meaning you actually own the share you're selling.
Exactly. And by mislabeling it, they avoid having their sale counted towards the total short interest. It's a way to fly under the radar, avoid scrutiny, and maybe even reduce the collateral they need.
And the third one, which we hear about a lot, is the creation of synthetic shares through naked shorting.
Right. Naked shorting is when you sell shares that you haven't even borrowed yet, or confirmed you can borrow. You're essentially creating a phantom share out of thin air. This artificially increases the supply, which pushes the price down. And those phantom shares don't always show up immediately in the short interest data. It further hides the true liability.
So if you put all that together, the rapidly growing reported number, the incentive to underreport, and then these three big concealment methods, the conclusion from your sources is pretty stark.
It is. If they are publicly admitting to 103 million, the actual functional short interest, the total number of shares they must buy back, could be astronomically higher.
Because of all these shadow shares.
Precisely. The reported number, as high as it is, might just be the tip of a very, very large iceberg.
And that iceberg of liability brings us to what the sources call the pressure cooker scenario. So you have this huge, maybe partially hidden obligation to buy. What are the market conditions that turn this from a problem into a full-blown crisis for the shorts?
The first condition is just how concentrated the bet is. This is an incredibly crowded trade.
What does that mean in terms of numbers?
We're talking about something like 20 to 25% of the entire all the tradable shares being sold short. To give you some context, a short interest of 10% is generally considered very high. At 20 to 25%, this is one of the most crowded trades in the market.
And what's the danger for the funds when a trade gets that crowded?
It creates systemic risk. If the price starts to move against them, they all get margin calls at the same time. because so many funds are in the exact same boat, one fund being forced to cover and buy back shares.
Drives the price up.
Which triggers margin calls for the next fund and the next, and you get this cascade. It's a domino effect.
A domino effect that depends entirely on them being able to find shares to buy, which leads to the liquidity crisis your sources mentioned.
Yes. The analysis here relies heavily on the behavior of the retail investors, the group they call the apes. The argument is that this group is holding the line and refusing to sell, end quote. And for a short squeeze to work, that's critical. The shorts need to buy 103 million shares, plus all the hidden ones. But if nobody's selling,
then the liquidity, the available shares to buy, just dries up.
It evaporates.
But wait a second, isn't relying on the emotional commitment of a huge decentralized group of individual traders, isn't that a massive potential point of failure for this whole theory?
That's the billion-dollar question. It's the ultimate psychological wild card. But from a pure market mechanics standpoint, the sources argue that it doesn't matter why they hold. The fact is, if the supply side of the equation disappears, then the guaranteed demand from the shorts has to chase fewer and fewer available shares. The price they have to pay to close their positions just goes up and up and up until someone is finally willing to sell.
That lack of supply creates this explosive squeeze potential. The sources also mention another trigger, the gamma squeeze. How is that different?
So a pure short squeeze is about shorts being forced to buy back their shares. A gamma squeeze comes from the options market.
Okay.
If the stock price rises above the strike price of a whole bunch of call options, those options are now in the money. The market makers who sold those calls now have to buy the actual stock to hedge their own risk against those options being exercised.
So it's another source of massive forced buying, but this time from the market makers hedging options.
Exactly. And the sources call this the spark in a powder keg. That sudden burst of buying from the gamma squeeze can be enough to push the price up sharply.
Which then triggers the margin calls on the actual short positions.
And that starts the short squeeze. One can trigger the other, leading to that cascading upward spiral we talked about.
So let's try and bring this all together. Let's summarize the verdict from your source materials.
The setup they lay out is pretty clear. You have short interest at multi-year highs, the trade is dangerously crowded, and the real numbers are probably much, much worse for the short sellers than what's being reported.
And the liquidity they need to get out of their positions is disappearing.
It's drying up.
This brings us to the final piece, which is the market psychology. How do the two camps, the institutions who are short and the retail investors who are long, look at the exact same number and see two completely different things?
Well, traditionally, high short interest is seen as a sign of fundamental weakness. The bears, the institutions, they believe the company is flawed, and the high short interest proves their point.
That the smart money is betting against it.
Right. But the long-term retail holders, the apes as they're called, they see that same data point and interpret it completely differently.
How so?
For them, it's not a fundamental indicator, it's a liability indicator. They see 103 million shares short, and they just see massive guaranteed future demand.
Their entire focus is on the market mechanics, not the company's balance sheet. The short interest is the thesis.
So what does it all mean? What's the final conclusion from the sources you shared?
It's unequivocal, really. When you synthesize the numbers, the mechanics, the psychology, their verdict is simple. The shorts are trapped.
Trapped by their own obligation.
Trapped by the obligation, the sheer size of the trade, and the refusal of the other side to sell them the shares they need to escape. The sources end with a final mantra, emphasizing Ed Diamond Hands, the commitment to hold no matter what.
If you found this helpful, hit that like button and subscribe for more.